There is a feeling every Nvidia holder has had this year. 85% revenue growth. Jensen Huang saying demand is utterly parabolic. Every number is real. And yet, a storage spin-off up 550%. Memory chips inside Nvidia's own GPUs up 68%. Nvidia up 12%. Did I pick the wrong version of AI? I went back and found the last time this showed up in history. 2 rows. One ends at 89% down and 25 years waiting. The other ends at 593% gains. Here's what I found when I did the research. The AI cycle has shifted underneath Nvidia, but its revenue has not caught up to that shift yet. And the market is pricing the shift before the numbers show it. From 2023 to 2025, the entire AI industry was in training mode. Building the models, you needed every Nvidia chip you could get and you paid whatever they charged. There was no alternative. But in 2026, the mode changed. The race to build is slowing down. The race to earn has started. And those two races need different hardware. Training needs raw power. You throw every chip at it. Inference, running the models millions of times for paying users, needs efficiency. Run it as cheaply as possible. Run it as many times as possible. So when the goal is efficiency, custom silicon starts to beat general purpose GPUs. Here's the part that connects directly to your money. Google, Amazon, Meta, and Microsoft, Nvidia's 4 largest customers, all have production-ready custom AI chips deployed in their own data centers right now. Not prototypes, in production today. Custom chips are already 27.8% of the AI server market. Remember that number. I will give you the threshold that matters at the close. So the market is not ignoring Nvidia's numbers. It is pricing what those numbers look like when its 4 biggest customers keep building around it. Nvidia's customers are building around it at exactly the workload growing fastest. There are 2 historical patterns for what happens when an infrastructure company reaches this point. The first one starts in March 2000. Cisco Systems made the routers and switches that made the internet run. More than 70% market share in high-performance networking equipment. Revenue was real. Technology was dominant. And on March 27, 2000, it became the most valuable company on earth, and more than $500 billion in market cap. That is roughly $900 billion in today's money. The internet was real. Carriers were spending $500 billion on new networks. Traffic was growing every quarter. But the orders had already peaked. The market started falling before the earnings showed anything wrong. I am certain every Cisco holder in mid-2000 looked at those revenue reports and thought the market is overreacting. The technology is still dominant. The numbers are still growing. That is the same thought you have had this year about Nvidia. Now think about what came next. In May 2001, Cisco reported its first quarterly loss. It wrote off $2.2 billion in inventory in a single quarter. That is more than the entire annual economic output of over 30 countries, gone in 90 days. The stock fell 89% from peak to trough. It did not recover its March 2000 high until December 2025. 25 years. Cisco was right about the internet. The infrastructure was real and essential. But the infrastructure company did not keep the money. The companies built on top of it did. Nvidia does not need a crash to face that same logic. It just needs its biggest customers to keep finding cheaper alternatives for the workload growing fastest. But there is a second road, and it ends very differently. ARM Holdings went public on September 14, 2023. IPO price $51 per share. The skeptics called it overpriced. The valuation was too rich, they said. As at May 29, 2026, ARM trades at $353, an all-time high. That is 593% from IPO price in under 3 years. The reason ARM won is almost the mirror image of the reason Cisco lost. ARM does not make chips. Think of ARM like the owner of a floor plan that every restaurant chain in the world uses to design their kitchen. McDonald's uses it. Wendy's uses it. The startup opening next door uses it. The floor plan owner never cooks a single burger. But every time anyone opens a kitchen, they pay for the plan. Every chip designer in the world, Apple, Google, Qualcomm, and now Amazon, Meta, and Microsoft, building their custom AI silicon, all built on ARM's floor plan. Here's what makes ARM different from Cisco. ARM wins if Nvidia holds its dominance. But ARM also wins if Nvidia's biggest customers build custom chips to replace it, because those custom chips are built on ARM's blueprint too. The Moat is not a product. It is an architecture embedded into the infrastructure of everyone who might compete with you. So the question for Nvidia, the question your portfolio needs answered, comes down to CUDA. Your AI software needs a way to talk to hardware chips. Think of it as a recipe book. Nvidia's version of that recipe book is called CUDA, and it only works in Nvidia's kitchen. Every AI company has spent years writing code in CUDA. To switch chips, you rewrite every recipe from scratch. That switching cost is real. So is CUDA more like ARM's floor plan, so deeply built in that no one can afford to leave, or more like Cisco's routing equipment, dominant until the next generation decided to build around it? Are you following that question? Because where you land on it is the answer to the feeling earlier on. The number that tells you is 27.8%. That is custom chips, what the industry calls ASICs, as a share of AI server shipments today. A general purpose GPU is like a Swiss Army knife. It can do everything. An ASIC is a bread knife. It only slices bread. But if all you do all day is slice bread, the bread knife beats the Swiss Army knife every time. That is what Nvidia's 4 biggest customers are building right now. Cheaper, faster tools for the one job they do most, running AI, not training it. If that number crosses 40% in the next 12 months, the Cisco pattern is in motion. If Nvidia holds above 70%, the ARM comparison holds. There is one more thing to know before you decide anything. Elon Musk's SAI is running 555,000 Nvidia GPUs right now and plans to reach 1 million by end of 2026. Tesla is spending $25 billion, roughly what Norway spends running its entire public healthcare system for a year on AI infrastructure in 2026. Both xAI and Tesla are on the spending side of this trade. They are Nvidia's customers, not Nvidia's competition. If you hold Tesla because you believe in Elon's vision of AI, you are holding a company that is right now paying Nvidia. The earnings from Tesla's AI investment, from robotaxi revenue to Optimus to FSD at scale, are 12 to 18 months away by Elon's own timeline. The spending is happening now. And this year, for the first time, a more direct version of the AI bet becomes publicly available. Anthropic is targeting a public listing at $900 billion. SpaceX's roadshow may begin this month. When the direct trade is available, the proxy gets repriced. That repricing has already started before a single retail share is sold. One more thing from this week. At GTC Taipei, Jensen announced the N1X, Nvidia's first ARM-based laptop chip, moving from the data center rack into the device in your bag. I put this out because it is relevant to the exact question this video asks. Is Nvidia building a second act beyond the data center? The full GTC Taipei breakdown is the next video, link in the description when it is up. 3 things to watch. 1. The custom ASIC market share number. It is at 27.8% of AI server shipments today. 40% is the threshold. 2. Nvidia's gross margin next quarter. It is at 74.9%, down from 78% 2 years ago. A small move. In a business where pricing power is the moat, it is the first signal. 3. The Anthropic IPO date. When a direct AI trade is publicly available, the proxy gets repriced. Watch what Nvidia does in the weeks around that listing. Nvidia supplies the picks and shovels to every gold rush in AI. But in every gold rush, someone eventually figures out how to mine without buying from the same guy. How long does Nvidia have before its biggest customers get there? If this breakdown is useful, hit like and subscribe. I go 3 layers deep every week.